includes, so this is what you could include on an application: wages, salaries, tips. Think of that as a W-2 income, part-time, full-time if they don't get coverage. Self-employment income. Think of this as a 1099, commissions, interest, dividends, capital gains, taxable Social Security benefits. So Social Security. In addition to that, think of Social Security disability income, SSDI, and unemployment benefits. It excludes non-taxable Social Security. This is SSI. I think one of the most frequent questions I get from agents is, "Hey, David, remind me, is SSI or SSDI included?" Just know SSDI is included as income, SSI is not. Child support, alimony, some other things on there. Always project annual income when applying. Someone might give you their 2025 or 2024 income and say, "Yep, this is what I made last year." No, it's a projection for the current year. So if they made 60,000 last year and they're like, "Yeah, I got a pay raise," or "My wife got a job, we're probably going to be making 90,000." Whatever you do, do not use last year's income. Use their projected income for the new year. You don't want to underestimate for your client. And at the end of the day, everyone, it is ultimately your client's determination what to put on an application, but please explain clearly why and what the risks of underestimating. Also, keep everything on a recorded phone line. You want to protect yourself as much as possible. Record any and every interaction when it comes to an application with your client and store those for up to 10 years. If you don't attend our compliance webinars, we do those every 2 weeks. I highly recommend jumping on, checking that out if you have not. Goes over all of compliance and how to protect yourself as an agent. Determining household size. So who's included? Obviously the applicant, a spouse, and any children or dependents that they claim on their tax return. So I'll run a quick scenario here. There is a husband, wife, okay? They have 3 kids. That would be a household of 5. Now, let's say the 3 kids are on CHIP. That is still a household of 5. Whether everyone or only one person is applying, you still include everyone in the tax household. So if only the primary applicant is applying, you would still put the spouse, you would still put the 3 kids, you would just indicate on the application that they are not applying. This is very critical because this is determining what and if they're eligible for premium tax credits. So you don't want to say, "Oh, if your spouse, your kid aren't applying, we'll just put you on there." Nope. Make sure you put everyone. Now, if there is a couple that is married, but they do not file their taxes jointly, they would not be eligible for a premium tax credit. So if they are married, yes, they must file their taxes jointly if they want to get a premium tax credit. Another one that gets asked to me a lot is, "Well, they say they file their taxes separate, but they are legally married." There are a few instances that they could be on there separate, but most cases they have to be filed jointly. Make sure you're doing things correctly and accurately. You don't want your clients to be blindsided by any penalties or repayments with the IRS. So just be sure that you are aware of the actual situation. Again, household size directly affects subsidy eligibility. So determining the household size is very critical and important. Make sure you do it accurately and correctly. Big thing is you don't want to under or overestimate premium tax credits for your clients. You want to do everything correct. Income versus the federal poverty level. ACA subsidies are based on a percentage of the FPL. Again, we shared the actual chart of this in our last presentation. I should have thrown it on here. My apologies. But you can go and look at that last one. I'd actually recommend doing so you can be aware of where that line is. It's a pretty short presentation too. I'd recommend just watching it. You can put it on 1.5 or 2 times speed and get through it within 10, 15 minutes. So example, the 2026 FPL. is 100% to 400% FPL are eligible for premium tax credits in the states that are not expanded Medicaid. Less than 100% FPL may qualify for Medicaid. So this would be a state, no, according to the state. So if someone's making $9,000 for the year, yeah, they're not going to be eligible for a marketplace premium tax credit plan. They're going to have to apply for Medicaid. Now, this year, it's a little interesting. The 400%, if someone's over 400% federal poverty limit, that actually is what you may have heard of the phrase or terminology 400% cliff. If someone is over 400%, they will not be eligible for any premium tax credits. Ultimately, this can be a pretty big jump. I was quoting an individual and his wife last week, and it was a household of two, and they told me, "Hey, David, we're probably going to make somewhere between 80,000 and 90,000. But let's just put 90,000 for the sake of, highest estimate." So we put the 90,000 for him and his spouse, no premium tax credits. Be mindful, this couple is about 60 years old, give or take, so their insurance cost is pretty expensive. And they were like, whoa, 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 we cannot afford this. It was expensive, over $1,000 a month. Then I'm like, well, let's just look hypothetically. You said anywhere from 80 to 90. Let's look at 85. We put in 85 and boom, like a $900 premium tax credit. And I said, okay, be mindful. Um, if you were to make over 85,000, you are going to pay back the premium tax credit. Or if you'd rather just pay it all now and then get a reimbursement at the end of the year,